This is Forensic Forex with Deontay, where we analyze the details and specifics of the foreign exchange market. In this video, I break down the London stop entry model. Traders should be aiming for simplicity. I will show you how to utilize the Asian session range high and low to find rewarding setups during London session. Stay tuned. Leave the indicators alone. This will be broken down into 3 steps, starting with core curriculum, chart activity, and lesson plan. Let's jump right into our core curriculum. For this model, your main focus will be on the Asian session and London session. Asian starts at 8 p.m. and ends at 12 a.m. New York Eastern Standard Time. London starts at 2 a.m. and ends at 5 a.m. New York Eastern Standard Time. Asian range ideology. The Asian session is creating market sentiment prior to 12 a.m. if the true day open. It is building in buy side and sell side sentiment. In this picture on the right, we can see that swing high is defining the Asian session high, and that swing low is defining the Asian session low. And between those swing points, the swing high and swing low, that is where the order sentiment buildup is occurring. This is step 1 to the model. We will define specifics, but for now, please follow along. The Asian session has the characteristic of accumulating the market. This consolidation is how the algorithm is capable of building up market orders and sentiment. This consolidation is defined by the Asian session high and Asian session low. We can see where the buy stops are residing, meaning those that are short are most likely having a stop loss above the high. Vice versa, we can see where the sell stops are residing, meaning those that are long most likely have a stop loss below the low. We also have retail traders who are waiting for a breakout opportunity. These traders are waiting for a break of the Asian session high to buy, and they're waiting for the break of the Asian session low to sell. Step 2 of this model, we must have one side of the Asian session range purge prior to London open. The key word is prior. You can see here in this example that the Asian session low was purged or broken before London open at 2 a.m. While this has happened, 2 things can be occurring. Traders who were once long place a protective stop loss below the Asian session low, and they are now taken out of the market because their stops have been hit. Also, traders who have the idea to sell at the Asian session low as a breakout idea are now triggered into the market short or going short. At this point, our main focus will be the Asian session high. We would like to see London session open and run towards the high. Step 3 includes you using a stop order. So you're going to be using a buy stop order at the Asian session high. You're anticipating that the London session will trigger you into the market long and continue the trend in that direction intraday. You are banking on the strength of the market to pull you into profit immediately. Since price has already lured traders to one side of the market early into the day, we can suspect a run back to the other side to be the intended move. This is what it would look like briefly. You're placing a buy stop order at the Asian session high. Once you've seen one side of the Asian session range, and as you can see, it's the low here, purge. So the Asian session range is purged, and then we're placing a buy stop order prior to 2 a.m. because we don't want to miss the entry point, because 2 a.m. can open and take you right up to that, and you haven't set your stop order, you're going to be upset. So place a stop order once you see the low is rated and you see the high is still intact prior to 2 a.m. Now, as we can see going forward, 2 a.m. opens and we're taking through that Asian session high like a rocket ship. It goes straight up. We can see we're buying at the Asian session high and speed immediately takes us into the market to the upside. After seeing that those were lured to the downside on breaking out on the Asian session low to the wrong side. The market's true intention was to go up. You can also see a parameter that I'm using here. My stop loss is the size of the Asian session range based on the pips. So I'm using the highest high of the Asian session range and the lowest low and measuring that. And as you can see for this example, I got 25.8 pips, which were the wicks, not the bodies. I'm using that as my stop loss. So I had a 25.8 pip stop loss and a 25.8 pip TP. So I'm using a 1-to-1 ratio here. I think it's very achievable, and it's basically one standard deviation of the Asian session range to the upside. So I'm using a range to give me a calculated TP and SL. Looking past the London session and looking into the New York session, which is shaded in blue, and the London close session, which is shaded in orange, we're able to trend a bit higher. Overall, we can see that 4 standard deviations was achieved here using the stop order model. Example, so we have the Asian session high where there's buy stop orders and the Asian session low where there's sell stop orders. That's our market order sentiment. So we want to see the Asian session range accumulating or being in a consolidation. Then we could go forward and see that the Asian session high was rated. We have a purge on it. Purge of buy side liquidity, purge on the buy stops. Now there's retail traders here at this point going long on the breakout, thinking that the market is going to continue trending that way. This is all happening prior to 2 a.m. You can see that the sell orders are still intact. The sell side liquidity is still available. Then we place a sell stop order at the Asian session low, and we put a stop loss order above the Asian session high. So you can see here in this example, the Asian session was 60 pips. That's with the wicks, so the highest wick and the lowest wick, or the highest swing high or the lowest swing low. We place a stop loss of that same range, and we place a TP of that same range. So we have a 1-to-1 ratio. We're risking 60 pips to gain 60 pips. We can see London kicks in and we go through that Asian session low. We're triggered in on weakness, and the market continues to sell off going into the London session. So all the way down to 5 a.m., we can see we acquired a 1-to-1 ratio with little to no drawdown once price triggered us in short there. So this is exactly how I would play a sell scenario. It's the same thing, but inverse to the buy scenario. For our chart activity, we're first going to open up a 15-minute chart and look for Asian ranges that are greater than 20 pips and less than 40 pips. Step 2, we're going to check to see if price raids one side of the Asian session range before London open. And step 3, we're going to study how the London session trades through the opposite side of the purge. So we're talking about when price purges either the buy side and reverts back down to sell side, or when price purges sell side and reverts back to buy side. So let's take a look at some examples. Looking at this example for GU, British Pound versus US dollar, on September 6th, Wednesday, 2023, we have the model play out here. We're going to walk through it together. The more examples we look at, and the more you guys do it yourself as time goes on, you'll get more familiar with the model. So let's take a look at this example. So first things first, we need to have the Asian session range within a certain pip requirement. It needs to be greater than 20 pips and less than 40. Do we have that? Yes. So from this swing low here, the lowest low, and swing high, the highest high, we got a 24.5 increment here. So we're going to keep that in mind for our stop loss in TP and partials. So we have our sell side below this low and our buy side above that high. We want to see which side is going to be purged or rated before 2 a.m. opening price, which is European open or London kill zone open. We play it forward. Do we have a purge? We have a purge here on the buy side. So buy side liquidity has been purged here. At this point, what can we speculate? We can speculate people that were potentially going down on a short had a stop loss above the high. They just got rated. We can also infer that people that was also looking for a long setup as well were waiting for a breakout retest probably and then go long, or just buying here with a buy stop. So price coming up and knocking them in long and continuing up in that direction. But we know we have to wait for the kill zone to find a trade opportunity. And this model is for us to simply catch the reversion of the purge. So the purge is going up here. We want to see price come down and revert back to this swing low. That's all we're looking for here for this model. So you play it forward, you can see we got that purge, 2 a.m. comes around. But where are we looking to go short? We're looking to go short at the Asian session low here. Now this is where the Asian session range, its TP is going to come into hand. Like I said, it was 24.5, I believe. So that's the size of the Asian session range. There we go. And then That's what our TP is going to be. We're going to make this a 1-to-1. So we're risking the 24.5 pips to either gain 24.5 pips. But we're not in the market short yet because we need price to come down to that stop order right in there. So until price gets there, then we're in the market short. We play it forward. London opens. You can see we hit the market here. So now we're in short right there. The stop order has been hit. And once it's been hit, we're going to hold based on the risk that we have set from the Asian session range, which is the Asian session high. And if you play it out, we can see price continues to trend in that direction, including the New York session and even London close session. So right at 12 would be the ending of my intraday trading. And we can see how we were able to get that TP1 here. And we can also see how if we had a position that we could take partials off of, we have TP1, we have TP2 here. That was it. So we got 1 standard deviation and 2 standard deviations hit right there for a potential max amount of, let's say before 12, of 67.6 pips, just based off of this model and that idea. Let's take a look at another example. This is British pound versus Japanese yen. Just want to show the yen crosses as well can follow suit in this model, not just the dollar crosses. As we can see with hindsight, the market does break the Asian session high prior to 2 a.m. open, and London does bring you back down to the Asian session low and trades a bit lower. So let's take a look at this together. So the first step is to have the Asian session range within 20 pips and 40 pips. That's our pip requirement for the filter of this model. So let's measure that. So from the low to the high, we got 21 pips. So it's just right there, meet the cutoff. It's above 20 pips. So we have the Asian session high, which is here, and the Asian session low, which is here. So we have buy side up here and sell side down here. And then we have buy side liquidity. At this point, we're waiting to see which side of the market's going to be purged. Is it the high or the low? Most likely, if the high is broken, we can suspect retail traders are going to buy the breakout and then place a stop loss down here. That's the whole idea. Those traders that are going to go long potentially, and we know with hindsight, it was the high that was broken. So let's play it forward. Traders are going long on that breakout. So let's say they went long here, where they're most likely going to put their stop loss below some type of low, whether it's that low, this low, this low, this low, this low. Odds are it's most likely maybe going to be a significant low, like the session's low, Asian session low. So there's stop loss here now. That's what the breakout traders are probably doing. We're going to try and counter that by using them as counterparty to our sells. They're going to buy, we're going to sell. They're going to purchase from us from a higher price, and we're going to sell to them at a higher price. We're acting as if we are the market makers here. Retail trader buys high, which is not correct. It is a disadvantage to you as a buyer to buy on a breakout. You want to most likely sell after breaking a high, ideally. Now at this point, we're waiting for price to come back down within the London session 2 to 5 a.m. to get us into the market short on a stop order on weakness. So we go short at the Asian session low here. And our stop loss is going to be 21 pips. And our TP is going to be the same thing as well. Now, if we were looking for multiple TPs or areas to scale out, it would be the same thing. So we're going to take a fib and get our standard deviations. So that's the first standard deviation here. This is the second standard deviation here. This is the third standard deviation here. So it's just multiples of the Asian session range. But the very first easy target is the TP1. So that's that 21 pips. So you play it forward. Still not. Now we're in short at this point. So we're in short. Now we're in drawdown. We can see now we're in profit. And we're looking for price to do what? Continue the push to that standard deviation 1 or TP1. And we can see that price hits TP1 and TP2. So you're able to get a 2-to-1 here. We're only risking that $1 essentially. So you got $2 risking $1. And if we play it out to 5, we were able to exceed that as well. So we're able to exceed, I believe that's 4 standard deviations of the Asian session range. So that's a great trade day. And as we can see throughout the day, intraday, it does come back up. But at that point, you would have already scaled out prior to New York. You would have hit all TPs there for the day and went home with your winnings. Let's take a look at another example. Canadian dollar versus Japanese yen. We can see here, August 16th, 2023, Wednesday, the market breaks the Asian session low prior to 2 a.m. open, and 2 a.m. allows you to get that buy stop entry at the Asian session high. So it's to measure the Asian session range, see if it falls in our pip requirement. It does. It's 22.8 pips. So if we bring it back here, and we find our Asian session high, which is here, and our Asian session low, which is here. At this point, we're going to see which side is rated first. We're going to see if it's buy side or sell side. So if we play it forward, you can see sell side is rated. So that means this players thinking that the market's going to probably continue to go lower. And we know that may not be the case all the time. We could probably see price go down and revert back up for some type of turtle soup setup. At this point, we're going to go long at the Asian session high and wait for London to now trigger us into the market short. Just make sure we got that correct. We do. So that's the Asian session high there. And we're going to bring this down to the Asian session low. And that's essentially what we're waiting for. Price to trigger us in at that price point there. We play it forward. And we want the same TP as well. We want it to be a 1-to-1 scenario that we're aiming for. You play it forward. We can see even after 12 p.m., we don't get that TP that we're waiting for. But if you do stay patient or you stay on ship, because some people do abandon ship and they close out before the market does take more away from them, or they hold till either side is hit, whether their TP or SL is hit. And you see as the day progresses, we do get that TP1 right up there. So 1 standard deviation of the Asian session range right here. So we get that touch. TP1 hit. So you were able to acquire 22.8 pips without taking a loss of 22.8 pips. So this is exactly how I like to utilize the Asian session range to help me find a London stop entry model. Overall, I do want traders to take home today. Ideally, you want the Asian session range within 20 to 40 pips. Now, as you study this model and get used to it, you'll notice that there are going to be times where the Asian session range does not fall within these pip range. It's going to be 19 pips or 13 or 15, whatever the case may be, and still give the model setup, or it might be 41, 42, and still give the setup. That's okay. But if you're going to be a strict trader, and you stick to these guidelines, it will prevent you from over trading. But if you're going to be a flexible trader, you may be taking more trades than you want to. So there's pros and cons to how you want to deal with that. I'm just showing the community what I do personally. Second, look for this setup on Monday, Tuesday, and Wednesday. I prefer those days because within the weekly range, those days tend to have more volume or more high impact news earlier in the week. Now, that doesn't mean Thursday and Friday, you can't see this setup unfold. It can as well. Third, use the Asian session standard deviations as targets and projections to the daily range expansion. This is a very simple approach for new traders, or even veterans or people that have been trading for a while, to understand simple metrics to find a TP and SL and where to scale out if the market were to trade higher in their favor. Generally, do not try and hunt this setup every single day. It's not going to happen in every single pair every day. Be patient with this model. This brings me to the end of the video. I hope this video was valuable to you as a trader. If you enjoyed this video, then I think you'll like these two as well. Please subscribe, like, or comment for more high quality Forex videos. As always, safe trading, leave the indicators alone, and peace.